My guest today, Michael Episcope, protecting his wealth by investing in real estate, and quickly discovered the advantages and joys of sharing what he found with others. Welcome to the National Real Estate Forum Podcast, episode 228. Thank you for joining me today. I'm Dr. Adam Gower, and this is the nationalrealestateforum.org, where I speak to the leaders of the crowdfund real estate industry so you can learn how to raise capital, build wealth, and earn passive income from crowdfund real estate deals. I'm having a lot of fun teaching again at Cal Poly this semester about real estate, investment, and finance, and naturally I'm structuring the course entirely around how to prudently invest in crowdfund real estate deals. I have 60 of the brightest students at Poly, mostly from the finance department, which was originally funded incidentally by the Orfler family real estate deals. I have 60 of the brightest students at Poly, mostly from the finance department, which was originally funded incidentally by the Orfler family, the founders of Kinko's, which was, you probably know, ultimately sold to FedEx. The students using my online course Principles of Crowdfund Real Estate Investing as the foundation for their learning, which actually makes it the only full semester accredited crowdfund real estate course in the country. It's a fascinating environment to teach in for me because as much as I teach, I also learn. And if you want to up your game in online real estate investing, what I'm doing is converting some of the more popular lectures into free online training for you. The first training addresses one of the great mistakes that just about everyone makes when online, and that can be a critical misjudgment when investing in a crowdfund real estate deal. If you want to learn what is this mistake and actually how to turn it around to your advantage, go ahead and register for some of these free lessons that I'm giving by going /origin. And of course, Origin is the name of the company founded by my guest today, Michael Episcope, who co-founded Origin Investments after having had a successful financial industry trading career. Michael and I think very much alike in that we both like to provide educational materials based on what we have learned for everybody's benefit. Although Michael did not start his career in real estate, his brand of professionalism is amongst the most polished and precise of any I have seen so far as I look at the crowdfund real estate industry, and the opportunities he offers are well worth taking a look at. Go to the show notes to today's episode at the nationalrealestateforum.org website, nreforum.org/origin, for links to Michael's website. And of course, don't forget to sign up for the free lessons I've put together for you by subscribing at the top of the page.
First of all, thank you so much for having me on the podcast. It's an honor. I've been to your website and looked at what you do, and I think we very much share a lot of the same philosophy in real estate investing. So it's great to be here today. You know, my career, this is actually my second career. My first career was in commodities trading. At the age of 19 years old, I got a summer job down at the Chicago Mercantile Exchange, and that was between my freshman and sophomore year of college at DePaul. And I didn't realize it back then. I thought it was a summer job, but it really became my second career. And I was down there for a total of about 16 years. I started trading for a hedge fund in 1997. I was managing their futures risk on their portfolio. And then after about a year or two, I went off on my own and started trading for another sort of subgroup within the hedge nine. I traded for the next 9 years. I had a great trading career. I was blessed. I ended up retiring from that business in 2005. And the reason why I left that business was that two things. Number one, computers started to come in and take the edge away from what I was doing. And I wasn't a good trader because I knew where the marks were going to be tomorrow or the next day. I couldn't see around corners. I was able to react to information in real time and process it very quickly. And that was my advantage and my edge. And when all that information started to move to the computers, it just changed the risk equation. That was one reason. And then the other reason was my life had changed. When I started trading, I was single. I had no kids, no family, no dependents. And when I was done in 2005, I had 2 kids, one more on the way. I was married and had stacked up enough chips where I was comfortable in life. And we have a saying here that you only have to get rich once. So my next part of my several years during my trading careers as a high net worth, a lot of it passively, and then I had watched As a young kid, my grandfather, who was a real estate investor in Chicago, managed his own properties on the west side of Chicago. I used to help him out in the summers and learned a lot there. And I saw firsthand the benefits of private real estate investing. And for me, I didn't want all of my assets in equities and bonds. And I really wanted to, I guess, take advantage of what I saw as an inefficient market. That is a market where it's not commoditized. Every piece of real estate is different. There's multiple strategies that you can follow. And that's when I decided to go back to school, educate myself. I got a master's in real estate in 2006. And then soon after that, I started Origin with my business partner in 2007, right around that time. And we've been at it now a little more than 11 years. And we built the firm originally around our own capital. And soon after that, I started Origin with my business partner in 2007, right around that time. And we've been at it now a little more than 11 years. And we built the firm originally around our own capital. And that was the beginning.
Well, so now that was quite a time to be starting. Tell me a little bit about what you were experiencing in the market and how you dealt with what was going on at that time. Because if you came in 2007, you were at the peak, right at the peak.
We were definitely at the peak. But, you know, there's obviously a little bit of luck in every career. And I think coming into 2007 in the market was quite lucky. Number one, we were only investing our own capital, and we were very cautious about what we were investing in. And when you don't manage outside money, it's a much different type of risk than risking your own money. You don't have to look at other people if things go wrong. And we had made some investments in 2007. We our really investment strategy in 2008 more towards buying whole loans and debt from banks looking for big edge. That was the avenue that we saw in the market at that time, where there was just tremendous opportunity. We saw loan pools going for 20, 30 cents on the dollar, and it was just a great way to pay all cash for assets, get in at a great basis, protect your money. And that was really how we got our feet wet and started the company in the beginning. In about 2009, we started gravitating, as the market changed, more towards value add, larger assets. And we also decided at that time, we kind of looked and said, what do we want to be when we grow up? And realized that in order to build the firm that we envisioned, it was really going to take larger pools of capital than just ours. And that's when we started inviting friends and family in, syndicating deals, building the platform, bringing in people, building the infrastructure along the way. And then it wasn't until about 2011 that we had started our fund business. So, you know, the period of 2007 to 2011 went sort of from a family office to those beginning stages of an organization, friends and family, to institutionalizing the process into the fund business and creating a dedicated strategy and a coherent business model and attracting outside partners. So that's kind of that 2007 to 11. But you're absolutely right to point out it was an auspicious time.
So now you started buying notes, which was actually what I was intensively working on selling at the time for institutions, just coincidentally. So, and did you buy portfolios of notes, and what was your exit strategy? You came out of the trading business. So were you just looking at trading those notes, or were you actually looking to get to the real estate at that time?
No, I think one thing that trading taught me is that you need an edge. And no matter what you do, what business model, there has to be an edge advantage. And it was very easy to see in 2008 that you looked at the notes, and while those are financial instruments, underneath those, what was backing them was a physical asset. And that physical asset had a value. And what we were able to do is really price the notes to a place where our money wasn't at risk. So we were going in, we were buying the notes with the intention of owning these, and ultimately would foreclose on the note or do a deed in lieu or do something to take it back, or we would cut a deal with the borrower to have him pay us off at a discount. So it was a great time for us to learn about the real estate market from a hands-on perspective, but it was really my partner and I doing all the work and using outside counsel to get to the real estate. And it was sort of a moment in time that we took advantage of that really helped us get to the next stage. But we bought some low-quality assets, we bought some high-quality assets, and we met some interesting people along the way, because they sell bad people. And when you're on the other side of a distressed note, you're inheriting those relationships.
So you moved from buying notes, which was highly opportunistic, and then you started orienting towards value add, and then started to look to a broader pool of investors. Has the strategy always been to look at opportunistic deals? It seems like it's somewhat less of a wealth preservation strategy than it is a wealth growth strategy to look at opportunistic and not long-term hold, lower risk type deals in real estate.
Yeah, but I would argue I don't think they're mutually exclusive to one another. You can preserve wealth and get into a great deal that has downside protection. And a lot of what we were doing in buying notes, we were getting into value-added properties, but we were getting in through the derivative of the physical property by buying into the note itself. And oftentimes we would buy a property that was 8 townhomes that were partially completed that we would ultimately take over, we would finish, and then we would sell into the open market. So our value add strategy was consistent from buying notes all the way to the point where we launched our fund strategy. But the real difference was that the market changed, that even in 2010 and 11, the market got incredibly crowded. We couldn't make sense of the pricing of the notes at that time, and we just decided that there was less risk in actually going out and buying the physical asset and owning it fee simple from day one and underwriting with perfect information than there was in buying notes at that time. You're correct in pointing out it was more of an opportunistic strategy, but I think that it wasn't mutually exclusive to say that we were opportunistic taking high risk. I would argue that when you're paying all cash for an asset that you can buy at 50% of its market value, you're actually taking very little risk with tremendous upside. And that's always been our investment philosophy, is looking at how do we generate high risk adjusted returns, take the least amount of risk and generate the highest risk adjusted returns. And that's what gravitated us towards the note business. It was not the risk, but the preservation of capital in that strategy.
For free lessons on how to maximize your real estate investment returns while minimizing risk, subscribe at the top of today's show notes page at the nationalrealestateforum.org website, nreforum.org/origin. Do you do any long-term hold investments, or are you typically add value and sell?
Our strategy today is buy, fix, sell in what we do. There's an argument to be made that some assets should be held longer than others. We underwrite between 3 and 5 years. All of our assets, our typical hold period is right around 3.5 years. Those were in some of our earlier funds. We took chips off the table after the value was added. But in Fund 3, we see, which is our current fund that we're allocating for right now, those hold periods will probably be closer to 4 or 5 years, because a much higher percentage of our overall return will be coming through cash flow rather than just the appreciation of the asset itself. And so in this next fund, that's what we're focusing on, is kind of a 50-50 combination of generating a 2x multiple on our capital through appreciation and income.
Okay, so before we start talking about the types of assets that you're looking at, let's spin back in time again a little bit to how you did start to expand your investor base and how you discovered what we might call crowdfunding and what it was that appealed to you about that.
We expanded into crowdfunding in about 2015, and it was sort of an aha moment that my partner and I were looking at what was happening in the market, and we're always trying to figure out how we can enhance our product, how we can build more value, how we can make it a better experience for our investors, even ourselves. And there was one day I was just sitting and I was doing my own reconciliation of a lot of the projects that I had at Origin, and I was on a spreadsheet, and I just realized that I had a problem. Like, I couldn't figure out my own positions, and it took me a long time. And I'm looking at a TD Ameritrade app, and it was so easy and beautiful, and you could see all of your investments in one place. So I went to my partner. I'm like, we got to build something like this. And he kind of, he thought it was interesting and intriguing. And I said, look, if we do this, ourselves apart from the crowd by building this technology, and we're going to have better communication. And our policy has always been to set the standard in the business and do something to differentiate ourselves. And ultimately, we both agreed, and we ended up investing a lot of money into our technology and our dashboard. And what that really allowed us to do was to start to market and create a lead generation tool. And we had both been in a business in the commodities trading world where we saw firsthand how computers had taken over an industry. And I think we both had agreed at that time that we're not going to watch this time as the market changes and we're still doing business the same way we were 20, 30 years ago. We believed in our product. We believed in our team, in our strategy, everything. And to me, if you have a great product and you put it in front of more people, you're going to get more people to consume it. And it was as simple as that. We started then traditional marketing in kind of late 2015, and our platform really resonated with a lot of people. And we brought people in on individual deals, and then ultimately, most of our investors now are in Fund 3 today. We have over 600 investors at the firm. When in 2015, prior to doing this thing, we had 65 investors. So it has been a great way to meet new partners, to share our platform with other individuals. And our mission is really to transform the way individuals invest in real estate. And everything we do now is consistent with that, about focusing on high net worth investors like ourselves so that they can realize the true benefits of this asset class.
When you had this epiphany, if you like, that you needed something that better reflected your own investments to yourself, and that would also open a window to other investor relationship that kind of evolved out of building the platform?
Well, in the beginning, when we were just concepting it wasn't. And then over that time, this is 2014, 15, I think the technology we built in 2014, and then we started marketing in 2015. We weren't that familiar with the Jobs Act, but we obviously became very familiar with the Jobs Act and why had this never come out before? Why was it happening now? So we got up to speed very, very quickly. And I think what resonated with the groups or our customer base is the fact that we were an operator coming into a market with a 10-year track record and two very successful funds in a market where most groups were aligning themselves as technology companies and not with the real estate part of it. Yeah. So we were really viewed as an expert in the funds in a market where most groups were aligning themselves as technology companies and not with the real estate part of it. Yeah. So we were really viewed as an expert in the market. And the other thing is that when they hear our story about how my partner and I built the firm, the fact that we're the largest investors, they look at our team and everything, they really see a difference in our platform relative to other offerings out there. So that is a big growth driver and what helped us stand out in the market and have the success we've seen today.
Yeah, it's a very interesting thing, actually. And going off on a total tangent, have you considered white labeling the platform?
We did consider it, but we're not going to do that. We have a lot of, we're actually insourcing all of our tech team right now. We have a lot of great plans on the drawing board for 2018, 19, and 20 and beyond. At one point, though, we talked about monetizing. Today, we don't have any interest. This is for our own use.
So how did you start marketing in the first place? Because that's, quite a challenge to go out and find investors. How did you do that? What kind of marketing were you doing?
Well, let me start with when my partner and I decided to start using traditional marketing to the firm, it was not well received by everybody at the firm because you have to remember a lot of the individuals who we have here have come from institutional companies like Reef and Equity Office and Starwood, et cetera. And that's just not how people market. And there's always been this notion that we were going to go from high net worth investors and then jump into the pension funds, endowments, institutional capital market, and that's how we would grow. And when we announced the fact that we were going to market our platform and apply traditional marketing to Origin, it was very controversial. And we said, look, we hear you, we get it, but we respectfully disagree, and this is what we're going to do. And we did it. And we did it with obviously a lot of risk. And over time, not everybody came on board, but I think that if you asked everybody in the firm today, they would tell you that it's the best thing that we've ever done for this firm, because today we have more capital demand than product. Because in private equity, you either have too much product and not enough capital, or too much capital and not enough product. It's just the balancing of this. And we have a tremendous amount of demand from our investment group for product, and it's helped to really launch this organization. So your question was really about how did we start marketing? We hired a marketing team. That's what we did. We went out and we hired Digital Kitchen, who's a top-notch agency here in Chicago. We helped them rebrand the company, produce a new web, tell our story, help us with the story, hired a marketing team, started on content strategy. We did everything, and we went all in. And it was incredibly expensive, but it was probably the best money that we've ever spent. And it came, the ROI on it has been tremendous.
Interesting. Let me jump back to actually something that you said. I am interested in that Digital Kitchen. I actually haven't heard of them, but I'm interested in finding out more. Had they had experience in crowdfunding real estate deals when you first approached them?
No, nobody has experience in crowdfunding real estate deals. What they have experience in, though, is branding and marketing and launching really, really cool concepts. And they don't just do it on companies. They do everything from videos to television shows to investor events to corporate branding, logo. I mean, they do it all, and they're one of the most, just creative agencies in all of Chicago, and probably a top 10 digital agency in the country. And what that did for us, we were actually written up as the #1 real estate website in the country by another website called Student of the Real Estate Game. So we were pleased to have that honor, and that was great. Now, what that meant was that we also had a lot of copycats of our website at that time. But I think Digital Kitchen, we owe them a great thanks for bringing our story to life.
So tell me something about the way that you moved from meeting somebody, right, through your marketing online and reaching the point that they actually wrote a check to invest with you. What is that process, and what does that actually involve?
There are a couple different avenues. Some of our investors come via referral, and that's obviously very different when you have a warm introduction and they meet you through that and they've already developed a sense of trust, because with any organization, that can be anywhere from a week to a month to 6 months where somebody signs up and there could be multiple conversations. When we get a cold lead, and that's what I'll call it, it could be that somebody signs up for our newsletter and they just receive educational material about us. It could be that somebody signs up for our portal and they're able to go in there and look at our deals and do due diligence. It could be that somebody signs up for our portal and requests a phone call. And we've put in all these steps in place, and we have an amazing investor relations team, very well experienced in not only our platform, but in the world of real estate, who have come up through the financial markets in real estate, underwriting, everything. So they know everything about our PPM, our documents, our legal structure, the asset level risk, the fund risk, everything. So they have knowledgeable conversations with anybody who wants to get to know us. And if anybody wants to talk to me and have a follow-up call, I'm always more than happy to do that. So a lot of times it's with anybody who wants to get to know us. And if anybody wants to talk to me and have a follow-up call, I'm always more than happy to do that. So a lot of times, people can just sign up and sort of sit on the side and never choose to invest and just read our educational material. And if somebody wants to invest, then, most likely it starts with signing up, having a call, getting to know us, asking for more materials, and then we go from there. But, the irony is today we closed out Fund 3 in July of last year, and we're not going to be raising capital for Fund 4 for another, call it 6 or 7 months, where we'll start raising. So today, there's no way for them to invest with us, but what we are doing is taking a waiting list for Fund 4. So the conversations it's a nice way to get to know somebody over a period of time when you don't know them. And by the way, it goes both ways. We like to get to know our partners as well, and that's really what the investor relations department does. It gets to know them, because there's really, it's a two-sided street, but to me, the best investor is one who understands fully what he's getting into. It scares me, and we've had people do this, where they come in and sign up on day one, And that's where problems get created because you haven't set expectations and then they learn along the way. So I would rather have somebody get to know us over time and really understand and see our value proposition and know exactly how our funds operate and what they can expect than just come in because a friend told them without knowing anything.
Right. So as you move towards Fund 4, how is your investment philosophy evolving?
Well, when you say how, what do you mean by how is it evolving? You mean how have we changed it from Fund 1?
Yeah, is it evolving? I suppose I shouldn't imply that it is evolving, but is it evolving in some way as the, for example, you've said you will first look at notes and then 3-year horizons. Now you're looking at 5-year in Fund 3. In Fund 4, do you anticipate, especially as we, in Fund 4, if it's in 6 months, we're getting deep into this cycle. So how are you thinking about the kinds of deals that you're going to be looking at and presenting to investors?
Right, and I'll answer that in two ways. One is our investment philosophy, and that doesn't really change from one fund to the other, but what does change is our product and our strategy and evolving with the market. And you're right to say, in 2008 and 9, it was the right environment to be buying notes. Now, we're not going to go back to there even if the market changes to that. We have a dedicated strategy, a team in Fund 3, Fund 4, but what we might do in Fund 4 is look at more of a more focused strategy on just multifamily. We haven't totally decided this yet, but as we're looking at our track record across multifamily and office, and the more we've narrowed the world down, the more successful we've been. So in Fund 1, we were more opportunistic. We could buy any asset class out there. So that was multifamily, office, student housing, retail. Fund 2 was office, industrial, and retail, and Fund 3 is office and multifamily. So, I'm sorry, Fund 2 was office, multifamily, and industrial. We dropped retail in Fund 2. And so we have actually had more success being more specialized. And as the world has normalized, you have to know how to operate at the margin in your asset classes and really understand the nuances. So where capital ruled the world in 2008, 9, 10, that's no longer the case today. It's really about having operational excellence and being able to spot pennies and being able to pick them up along the way. Now, I think in terms of our risk philosophy, what I would say is that we view everything through the lens of risk management, and that's all encompassing at every level. And we view it from the team, who we hire, how we compensate them, how we retain them. Because to me, the team is always the greatest asset of an organization, and it defines who you are, where you're going, and how well you're going to get there. We have 22 people, and we hire the best talent from institutional organizations, and that's consistent with our philosophy about delivering an institutional product to individual investors. You have to have an institutional team, and that's where it starts. The second one I would say is how do we deploy our resources? And we look at that from who is in the individual seats. We have dedicated acquisition team. We have dedicated asset management team. We have a dedicated team. We have a dedicated investor relations team. And then within those resources, we have boots on the ground. So our acquisition team is in their markets. They live there. They know block by block, building by building. And that's a lot of managing the risk, but also gaining the edge. Because understanding not only the buildings, but who owns them, who the brokers are, making sure that you're the first on the call, having a dedicated off-market sourcing strategy is really important to what we do. And then it comes to once you decide to acquire an asset, then what do you look for in the qualities? How do you finance it? And then that's managing risk at the asset level. And what we look for, high quality real estate with solvable problems. We make realistic, conservative assumptions in our underwriting. We don't take on complex projects. And our goal is that when we lose, we still want to make 8 to 10% on our money. And that comes with a lot of stress, extraordinary risk, and complex projects. We use leverage responsibly. We leverage 65 to 70%. We don't guarantee debt. We don't use mezzanine debt. We don't use preferred equity in our capital structures. We want to make sure that we're doing all of those things to ensure that our capital is protected, but has a really good chance, and I should say has a really good chance of winning. And I would say, lastly, when I think about investment philosophy, I think about the firm and our external customer base. And I think one thing my partner and I have always done is we treat people fairly. And we manage to the product and not necessarily to the bottom line all the time. And that's just taking the long view. And our philosophy is that if we can deliver the best product in the market, that's the way we grow. It's not delivering the best product at the highest price. It's delivering the best product at a fair price. And so both sides win.
Tell me, how knowledgeable are you finding investors when they come to you the first time? Are they sophisticated real estate investors, or is there a need to educate, do you think? And obviously, it's a broad sweep, but...
It's a great question. We only serve the accredited investor market. So that implies that somebody has essentially $1 million of net worth or more. Now, what that doesn't imply is that they know anything about real estate. And our customer base really consists of people who are at the minimum threshold of $1 million and also billion-dollar family offices. But regardless of who it is, there is absolutely an educational process that has to take place, because every firm is nuanced and their experience with another firm is going to be different than their experience setting expectations, making sure they understand who we are, our investment philosophy, our team, how we make money, what is in our control, what's not in our control. But I would say no matter who you're dealing with, regardless of how much money they have, there is always an educational process. Now, there are certainly some people who are more experienced in the market than others, but education is the key along the way.
And your minimums, from what I can tell from the website, are typically 100,000 plus. Is that right?
That's correct. We operate in a fund structure, though, which means that money, anybody who's in Fund 3 will have that money spread across 15 to 20 deals. So if you look at it from that perspective, your average investment is going to be $5,000 to $7,000 per deal.
Okay, I see. So the reason I was asking about the level of experience and knowledge of your customers was to kind of tie back again to what you were talking about having an institutional team in-house and the decision that you made to move away from private equity and go to the crowd. It sounds like it's a lot more work. Tell me about the experience of doing that, and what have been the biggest challenges and the biggest surprises, if you like, of having made that decision, both for you and also for your team?
Let me start with why we're doing it. And I think that it's really satisfying because my partner and I, we are investors. And again, we built this firm around our own capital and around our own needs. And that has really helped us attract other like-minded investors and friends. And it's unbelievably satisfying when you get an email from an investor that says, "Thank you for starting Origin," or "Hey, great job. This feels really good. You guys are the best performing investment in my portfolio." It feels really good. And when you see the other choices out there, you almost feel like this is something that you have to do and continue to serve this market, because the history of most firms is that, again, they start with the high net worth and then they go into the pension fund and institutional market and they leave the high net worth investors behind. And what we've decided is that we're going to actually do the opposite. And we don't think that we're sacrificing. In fact, we think we can be a much more valuable company by doing this. If we can have 10,000 investors under our umbrella and provide them with great service, communication, products, everything that comes along with it, then they're not only getting a great product, but we have an incredibly valuable firm and something that nobody else has been able to do. So I wouldn't, this isn't mutually exclusive. And I would argue that if we have 10,000 been able to do, so I wouldn't, this isn't mutually exclusive. And I would argue that if we have 10,000 investors and $5 billion under management versus 10 institutional investors and $5 billion under management, we're worth a heck of a lot more from the individual side, because it's something that nobody has been able to do. And that's what drives us. That's what motivates our team. It's a challenge, and it's what keeps me going as well. It's fun, and we really enjoy. Yeah.
It's extremely interesting that you say that, to go from 600 to 10,000. So that, of course, begs the question, do you have any aspirations to start investing in third-party deals and underwriting them and acting kind of as an aggregator and becoming private equity and funneling that kind of investment into other deals? And not managing it?
That is a very astute question, and one I'm not drawing board that we'll be announcing later on in 2018, 2019. You'll be the first to know, Adam.
Interesting. Okay, good.
But yes, you're right. I mean, you rightly pointed out 10,000 investors. One of the most challenging things with real estate is scalability, and we're solving those problems right now.
What are the key daily habits that you have that make you personally and your business successful?
Great question. The first is, I believe you have to emulate the behavior you want. And you mentioned both personal and business, and I do that at both home and work. And at work, at Origin, I work just as hard as any team member here. And I think that it's sometimes a mistake where, the old saying, do as I say, not as I do. I don't think that works for any culture. I come in at the same time everybody else does, sometimes earlier. I leave 6 or 7 o'clock at night. I get my work done. Do what I need to do. But I have high expectations for the team and myself, and I can't hold the team accountable if I don't hold myself accountable to those same standards. The second thing that is really something I've learned over the years, because in my previous career, I really didn't manage people. But in this role, I have more direct reports than I ever thought I would. And I realized that providing clarity to the team and making sure that they understand exactly what their role is in the greater organization is really, really important. So that communication, staying in front of them, having a relationship, having an open door policy is really, really important. And I try to do that with my family as well on that side. And my wife and I talk all the time, and my kids. And that really brings me to my last thing. I think that in order to have a successful career, you have to be happy at home. And I have a balanced personal and professional life, and it's something that I talk to with my team. And I have no qualms about it when I have to leave at 4 o'clock some days and go to a baseball game to coach it, or spend some time with my kids, or go to a play. Those are things that you only have a moment in life, and you're not on earth that long. And I don't want to look back and think about all the times, the plays I missed and the baseball games. I want to be at those. And it's important what I do, but there's other hours in the day that if I need to get work done, I can go to the baseball game and get work done at 8 o'clock at night after the kids go to bed. So that's really, really important, having that work-life balance. And it's important, I think, for all of your team members under you as well. And I think that people also have to be recognized when they do a good job, and a little pat on the back, great job, recognizing them with pay, promotion, whatever it might be, is important when you're dealing with any organization. So those are the things that I try to do, but I always can be better at them as well.
Right. Second question. What has been the hardest lesson you have learned in real estate?
Great question. The hardest lesson I've ever learned in real estate, I think the biggest lesson is that there are hidden risks that just can't be quantified. And I think all too often people think about real estate as just the physical asset, and it's really about people. And you can't quantify sometimes the risk of a partner or how they will behave when things go wrong. And that was something that I realized early on in my investing career, even pre-Origin, that generally real estate doesn't go bad. Problems walk on 2 feet, and the real estate goes bad because you have somebody who is over their skis or inept or hiding information, and there's nothing more frustrating than that. And that's what I would say was the biggest learning experience, is that you have to choose your partners really, really carefully. And, as an example, one of the worst deals that we've ever done at Origin was in our Fund 1. We ended up doing fine on the deal. We made a small return, 9%, but we sold it after a year and a day. And it wasn't to get rid of the real estate. It was to get rid of the partner on the deal. We had figured out pretty early on that he was not the operational expert he claimed to be, and we removed him to the project, and then he became a nuisance, and a bad partner along the way, and so we ended up selling the deal. And that was a lesson that we learned.
All right, final of 3 questions. If you could give one piece of advice to somebody who has not yet invested in real estate but is considering investing, what would it be?
Does it have to be just one?
No, many as you like.
All right, let me give you this in 2 parts. Number 1, educate yourself on the subject. There are great resources. Adam, you have a great blog. We constantly put out a lot of educational material on our sites. It's very easy to educate yourself not only on real estate, but just about the ecosystem, what's out there, how to invest. And then it goes back to what I just alluded to, which is in this business, you bet on the jockey and not the horse. And this isn't about just real estate. Focus on the team, the bright and shiny buildings, high returns, low fees, all of the other marketing tricks that people use to get you in there. Look for experienced operators, good track records, good balance sheet, everything that you can think of. And what was interesting, we had an institution in here the other day who was talking to us about potentially coming into Fund 4, and they didn't ask us one single question about our track record or our strategy or anything else. They focused on the people here. They focused on the retention policies. They focused on the relationship between me and my partner, how we overcome disagreements, what disagreements we've had in the past, succession planning, things like that. Because what they're looking at, and this is the way everybody should do this, when you invest with somebody, it shouldn't just be in one deal and done. You should be looking for a partner for a long time into a string of deals that you can invest with for 10 years. Because once you get the partner right, then everything else is easy. And that's what institutions know and understand and do so well. And I think that is the biggest kind of disconnect between the way an individual underwrites deals and sponsors and the way an institution does it, is that the individuals focus on the deal and the institutions focus so much on the sponsor and those intangibles within the structure. So I would tell any investor that that's where they should start. Again, bet on the jockey, not the horse.
I really like Michael's pivot away from the institutional capital option, while nevertheless preserving institutional caliber standards and integrity. While adopting the philosophy that Michael does, the idea that the crowd provides a developer with a more stable foundation upon which to build a platform for growth is actually a fascinating thesis. In fact, it illustrates one of the many aspects of the industry that I like about real estate, that it can be actually whatever you want it to be. For Michael, sharing the benefits of the platform he originally built for himself to preserve his own wealth with others is a mission worth pursuing. And for me, building a platform of educational content that is based on my own career is also a mission worth pursuing, something I really enjoy. Anyway, I'm looking forward to seeing Origin as they continue their growth trajectory, and I encourage you to take a look at their website. You can find a link at today's show notes at the National Real Estate Forum.org website, nreforum.org/origin. My next guest is Jason Schwetz of TripleNetZero.com, who is interestingly an introduction through one of my students. I tasked them with finding every CFRE site in the US, and one of them, Austin, actually took the initiative. And if you are interested in lower risk, decent return real estate investing, you'll find Jason's strategy quite compelling, I'm sure. And be sure to subscribe to the series so you don't miss the conversation with Jason or with anybody else by going to the National Real Estate Forum.org website, nreforum.org, and hitting any of the links that I've included about halfway down the homepage. Thanks for tuning in, and thanks again also to Michael Episcope of Origin Investments, for sharing your time with me today. Until next time, this is Dr. Adam Gower signing off.